Let me bring on board now Nilesh Shah, Axis Direct. Nilesh, 2011 was a tough, rough and a volatile year for Indian investors. Do you think the story for 2012 could be different, or we are likely to sustain this tunnel for an extended period of time?
In 2011, we started the year with optimism on the back of record inflows of $30 billion around by FIIs. And towards the end of the year, a barrage of bad news resulted into markets correcting by more than 25% in rupee terms. 2012, we are starting virtually on the note of, real pessimism, real skepticism. So, by definition, it probably feels appropriate to say that 2012 could be different, because generally the correction, the bear market starts on optimism, never on skepticism or pessimism. If we look at from a fundamental point of view, the whole of 2011 gave an impression of deteriorating macros. GDP growth declined from 8% plus to 7% minus. Inflation proved to be sticky and hovered above 9% for a long period of time. Interest rates kept on moving up, both on the policy side as well as market yield side. Currency towards the second half deteriorated from 44 to 52. So there was not a single macro which supported markets. It just kept on deteriorating throughout the year. Now probably in 2012 second half, we could see growth recovering from 7% minus to 7% plus, if not to 8%. We could see inflation, which has remained sticky, easing off probably in the first half itself. The currency, while probably the downward momentum may continue for a while, but it should start getting supported with the steps taken by the RBI, and also exports recovering on the basis of currency depreciation. So the macro, which deteriorated for the whole of 2011, towards the second half will start supporting, and hopefully that should result into a far better 2012 compared to 2011.
Nilesh, capital preservation was the name of the game for 2011. So where should investors dip their toes this year, and where, to your mind, there is a big bargain trade in this market?
I think the investors will have to look at opportunities across the markets, not only in equities but also in fixed income, also in commodities like gold, and also in currency market if one is comfortable. In the first half, we think probably it's worth playing duration on the fixed income side. In the month of December, we have seen rally across fixed income, but you still have certain mispriced opportunities coming through the IPOs in the bond market side, and some of the bond yields, which in the secondary market provides very attractive opportunity. So in the fixed income space, it's worth heading duration, notwithstanding the rally which we have seen in the market in the month of December, especially in the IPO of bond markets and the secondary market opportunities in bond market. In the equities, we think you will have to create a strategy to play out the volatility. The markets are unlikely to give a unidirectional move in the first half of current year. It's possible that markets may continue to behave volatile as it behaved last year. In the 2011, if we see the average volatility, it was about 9% a month, which is fairly large. And we think that kind of behavior will continue in first half of 2012 also. So if on a falling market, on a day when the markets are correcting, crashing, if you can build portfolios around pharma, banking and financial services, small and mid cap, and some infrastructure companies, probably that combination of basket will not only provide capital protection towards the second half, but also return opportunity towards the second half.
Nilesh, what do you think the RBI is going to do in its Jan policy? Because, there are divergent views coming in. You've got the governor who came out and said that, clearly it's now RBI's target is growth and not inflation, because that seems to be peaking out in any case. We had Shubir Gokarn, come out yesterday and say that it's too early to expect a reversal in RBI's rate stance.
I think what RBI has tried to convey is to manage the expectations of the market. Clearly in the last credit policy, they have announced that interest rate cycle is peaking out, and they need to concern about growth also. However, the stickiness of inflation is probably making them take action little later rather than little earlier. What we have heard from both the governor as well as the deputy governor, the message is clear that interest rate cycle has peaked out. However, don't expect a rate cut soon because we need to worry about inflation also. However, anything which is needed to support growth apart from rate cut alone will probably be carried out by RBI. So it could be in the form of liquidity enhancements. So one can either expect OMOs to continue, which provide some sort of liquidity, and also take away pressure from the government's borrowing program, which in turn then influences interest rates. The second thing could be related to CRR cut, which might also enhance liquidity, and higher liquidity in turn will moderate interest rate. One thing which we need to keep in mind is that by providing this clear-cut signal that interest rates are peaking out, we have seen market yields coming below the policy rates. Today the 10-year yield is trading below policy rate on repo rate side, and if this trend continues, then probably the need to cut policy rates little later can be accommodated within the current market structure.